Hi, it's Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Thursday morning, October 8th, 2015, and the title of this week's audio blog is Silver, More Than Ever, the Financial System's Achilles Heel. Well, it's days like today that challenge me the most, as I have to challenge my personal angst and frustration with my professional duties. Clearly, no task is too daunting, as I have been writing and speaking daily of rigged markets, particularly precious metals, economic misery, corruption, and unrest for 13 years. Not to mention unrelenting, exploding lies and propaganda from bad guys like Washington, Wall Street, and the MSM to supposed good guys like the myriad wolves in sheep's clothing that purport to be bullish on precious metals. It wears one down after this long, and now that I've done so full-time for 4 years as Miles Franklin's marketing director, you can imagine how all-encompassing the stresses can become. Thankfully, I exited my last paper PM investment in the summer of 2011, as not only do I enjoy the sleep of the just as a result, but financially speaking, I'm standing tall, well-positioned to capitalize on the inevitable and perhaps imminent demise of history's largest fiat Ponzi scheme. Moreover, my determination to succeed, or better put, my fear of failure, drives me to work harder as more obstacles are put in my way. As they say, when the going gets tough, the tough get going. And nothing I've experienced, aside from owning mining stocks from 2007 to 2011 and working for mining companies from 2006 to 2011, has been as frustrating, torturous, and demoralizing as fighting the gold cartel since it went hog wild in 2011 and berserk in 2013. To that end, I'm proud to say, I haven't missed a day of writing or speaking in at least 2.5 years, and though I've surely earned it, it's unlikely I'll stop fighting until the job is done, completely and thoroughly. Thankfully, Miles Franklin has given me the perfect platform to utilize my unique skill set in using my backgrounds in financial analysis, marketing, and communicating to help people protect themselves from what I know is coming to the Western world, and in many other places already has. Consequently, my knowledge base is multiplied exponentially, my writing and communicating has become more concise, and my Rolodex grown to include some of the best and brightest people in our industry, which, cumulatively speaking, has increased the level of confidence in my views parabolically. To that end, I have been dead on with my macroeconomic and monetary predictions for as long as I can remember, with only history's most egregiously rigged markets preventing me, thus far, from realizing my ultimate goals. In due time, my friends, for both me and those wise enough to protect themselves from what's coming. That said, until said endgame arrives, which again already has in so many other parts of the world, I advise you to be as careful as possible with your finances. In times of crisis, debt, speculation, and carelessness are your worst enemies, and as we speak, we are headed into the greatest economic, political, and social crisis since World War II. Regarding being dead right, this week alone I started with October down, infinity to go, of how, following the unexpectedly catastrophic September NFP jobs report, the Fed's last hope of a 2015 rate hike has been pushed to LOL, the December 16th meeting mere days before Christmas. That, of course, would never happen, as such a catastrophically stupid action would not only take the entire global economy down, but jeopardize Wall Street year-end bonuses. More likely, the focus will now shift to 2016, when election year stock support makes such a move all but impossible. Not to mention the rapidly collapsing global economy, which is why none other than Goldman Sachs 3 days ago espoused ZERP until at least 2017. And oh yeah, Whirlybird Janet 3 weeks ago, before the economic data has since gotten much worse, all but suggested the possibility of ZERP forever. And how about that? After unexpectedly miserable retail sales and industrial production in Japan earlier this week, and this morning, the biggest plunge in machine orders in at least the decade that they've had this data, expectations of a further expansion of Abenomics at the Bank of Japan's October 30th meeting have surged. Next, it was Europe's turn to jack up the printing presses, spurred by a monstrous, unexpected 5.2% plunge in German exports, and the first negative CPI print since, drumroll please, March 2015, when its historic open-ended QE scheme, which was further expanded in both May and September, commenced. Not to mention last night's shocking announcement that Germany's largest bank, Deutsche Bank, pre-announced a whopping 6.2 billion euro loss for the third quarter and the likely elimination of its dividend. Yes, Deutsche Bank, Europe's largest underwriter of off-balance sheet derivatives, which 2 years ago U.S. FDIC Vice Chairman Thomas Hoenig deemed horribly undercapitalized, is, quote, writing down the value of its two biggest divisions and boosting its reserve for legal costs. Meanwhile, just hours before, the Bundesbank published a so-called bar list of all its foreign-held gold reserves, as if it's worth the paper it's written on, given how said gold will never be repatriated, audited, or likely even viewed, assuming it even exists. Is there a connection between these two events? I haven't the slightest clue, but what I do know is German banks are in trouble, and trust me, Volkswagen's Dieselgate scandal won't help matters. As is the entire chronically insolvent European banking sector, as evidenced by the piggy bank announcement by Credit Suisse this morning, Switzerland's second largest bank, which happens to be the same size as Deutsche Bank, in, quote, preparing to launch a substantial capital raising. In response, the ECB expanded QE again for the second time in 5 months via the craven, surreptitious means of, quote, front-loading its fall debt monetization schedule to account for the mythical seasonal volatility reductions. Better yet, the Bank of England, at its regularly scheduled meeting, the same Bank of England whose newly appointed head, former Goldman Sachs banker Mark Carney, just 6 weeks ago hinted at raising rates off the zero bound as early as this fall, like the Fed last month, turned tail completely, while maintaining rates at 0.5% for the 85th straight month, predicted, quote, inflation would remain close to zero for longer than anticipated, likely below 1% until spring 2016. In other words, pushing their own doomed monetary policy towards the inevitable ZERP, or perhaps like the ECB NERP, to infinity policy we all know is coming. And last but not least on the ZERP to infinity parade, Indian Central Bank Governor Raghuram Rajan, who happens to be the former chief economist of the IMF, uttered 6 words this morning that will likely seal the deal of central bank monetary infamy, when he espoused, with the Indian rupee hovering near its all-time low, that the world economy is looking grim. In other words, India, which has been aggressively, and again, unexpectedly reducing rates this year, is on the same head-on course with the zero bound as the other 100-plus global participants in the now nuclear final currency war. And this, as Indian gold demand is hitting a new all-time high. But don't worry, the king of the wolves in sheep's clothing, Kitco, the leading Canadian precious metal bullion dealer that has been operating under the Canadian equivalent of Chapter 11 protection since June 2011, was available as usual with its modern-day cater of John Nadler clones to somehow spin such wildly precious metal bullish news with a top story titled Gold to Suffer by Year-End 2016 Due to U.S. Rate Hikes, claims a top full gold forecaster. Yes, a top gold forecaster that no one has ever heard of, whose smarmy accompanying photo makes me wonder if he's graduated college yet, claims the Fed will be raising rates by a whopping 25 basis points in December, and furthermore in 2016, causing gold to fall to 1050 by the end of this year and 950 in 2016. I mean, you simply can't make this stuff up, as frankly, even the most villainous archenemies of gold on Wall Street wouldn't resort to such idiocy. I mean, the Fed has been promising rate increases since it first introduced the propaganda buzzword tapering 2.5 years ago. And after Whirlybird Janet's hinting at ZERP to infinity 3 weeks ago, which has been since followed by a slew of worldwide news items suggesting all central banks are considering the same, how on earth could anyone make such a ridiculous conclusion? Not to mention the very day of a, quote, blistering 10-year Treasury auction in which foreign central banks, obviously anticipating the imminent launch of QE4, took up more U.S. Treasuries than all but one auction in U.S. history. Let alone, as dollar-price gold has already been driven 40% from its 2011 highs, to the point that global demand has surged to a record high, inventories to a record low, and the mining industry to the point of bankruptcy. Oh well, maybe someday we'll learn how a major precious metal purveyor could miss a 15-year bull market in its own product entirely. Yes, in most currencies, gold is at or near an all-time high, and in the process be more antagonistic to it than the gold cartel itself. Or for that matter, how a company can still be operating in bankruptcy protection more than 5 years after it filed. Elsewhere in the world of wildly precious metal news from the past 24 hours alone, the Russian attacks on Syria, and stationing of troops within have prompted NATO to threaten sending its own soldiers into an already frighteningly unstable situation. Meanwhile, Brazil's latest offshore oil lease auction was a complete failure, while its fellow oil-dependent South American basket case Venezuela is lapsing into an all-out hyperinflationary nightmare. Don't worry, the collapse of an entire commodity-dependent continent couldn't possibly be positive for precious metals or negative for stocks. Or how about the revelation that Glencore's debt exposure is as much as $100 billion, or plunging oil prices following another massive DOE inventory build, or Fitch officially declaring a Ukrainian bond default, or the biotech sector, after social media, the biggest bubble in the entire U.S. stock market, experiencing its first trading death cross, i.e. its 50-day moving average falling below its 200-day moving average in 4 years, etc., etc., etc. But hey, no one could accuse me of ignoring LOL good news like this morning's, quote, lowest weekly jobless claims in 42 years. You know, following last Friday's catastrophic NFP employment report and Challenger & Company reporting that 2015 is on pace to see the largest amount of corporate layoffs since, drumroll please, 2009, led by, I might add, high-paying positions at leading companies like Hewlett-Packard, Target, Schlumberger, and Microsoft. Which, to put an exclamation point on America's current employment recession, was actually spun by recovery propagandist extraordinaire CNBC as, quote, possibly signaling the end of the expansion, as if there was a real expansion in the first place. But kudos to CNBC for once, actually coming close to the truth. Moreover, if this were an article and not an audio blog, I'd be posting a chart depicting the 100% correlation between said plunging jobless claims and the U.S. labor participation rate since the 2009 crisis, which of course is due to the transitioning of the U.S. to a, quote, gig economy in which the vast majority of new jobs are of the part-time variety that do not qualify for unemployment insurance. Not to mention a chart showing how, from 2004 to 2008, the Fed's balance sheet and the labor participation rate essentially flatlined, at $1 trillion or so for the former and 66% for the latter. However, since QE and ZIRP commenced in 2008, the Fed's balance sheet has ballooned by 4.5 times to $4.5 trillion, whilst the labor participation rate has plunged to a 38-year low of 62.4% and an all-time low for males. Pretty damning for the concept of money printing, huh? And yet, just yesterday, per what I wrote in yesterday's article, Bernanke the Hero, Part 2, Helicopter Ben actually said, I kid you not, that the biggest impact of QE was to create jobs. Thus, you can see why, on a daily basis, my head is literally exploding with the stresses related to compiling so much ugliness, interpreting and communicating it, and of course, watching manipulation operatives like the PPT support stocks, the Fed support bonds, and the Exchange Stabilization Fund toss paper precious metals around like rag dolls as part of its little-known but publicly stated mission statement of, quote, dealing in gold and foreign exchange to stabilize the exchange value of the dollar. Which brings me to Wednesday's article, Peak Manipulation, describing this week's over-the-top, desperation attempts to calm burgeoning precious metal sentiment, arrest flagging equity and fixed income demand, and revive collapsing commodities, particularly with the specter of a Lehman-like collapse of Glencore taking on the characteristics of a clear and present danger. I know I've said this before, but never in my 26 years of market watching, including 13.5 years of watching precious metals tick for tick, have I seen such blatant efforts to suppress prices, and conversely to prevent stock prices in last-to-go markets like the Dow Jones Propaganda Average from collapsing, which they surely would if the PPD took its foot off the gas for mere minutes. Yesterday, gold was again capped at the cartel's newest line in the sand at $11.50 per ounce, whilst incredibly, silver actually closed higher for the fourth straight day, despite blatant capping with the ubiquitous Cartel Herald algorithm at the equally ubiquitous 12 o'clock p.m. Eastern Standard Time, cap of last resort key attack time. Actually, silver, which for 2 months Miles Franklin has been relentlessly discussing retail shortages in, closed a penny above the cartel's current $16 per ounce line in the sand, and more importantly, above its 200-day moving average, currently at $15.96 per ounce, for the first time in 4 months. Here at the Miles Franklin blog, we have long deemed precious metals the Achilles heel of the financial system due to the fear engendered by rising prices, of global economic collapse, and the potential for worthless fiat currencies to be replaced by the only real money the world has ever known. And clearly, if the world at large gets that scared, as we saw in spades in 2008, you know the powers that be are trebly so, as their power base is rooted solely in the continuation of history's largest fiat currency Ponzi scheme. Given that global demand has surged to record highs and inventories to record lows, whilst the mining production outlook is completely imploded, the manipulation of said money is clearly accelerating the inevitable end of said scheme forward at an exponential pace. In other words, it's only a matter of time at this point, and given that silver's physical supply-demand imbalance is so grossly out of whack, it's all but certain that, as in 2008, it will overwhelm the cartel first. Yesterday, my weekly Kerry Lutz podcast was titled, by him, not me, Silver Defying the Trolls, referring to its extremely strong performance despite said manipulations. Which is why it's not surprising that just hours later, at exactly the same time as July's Sunday night paper massacre, when paper gold was taken down $52 an ounce in 5 minutes on a thinly traded July Sunday night in Asia, the cartel struck again, taking paper silver down 30 cents per ounce, or 2%, in mere minutes, whilst not a single other market budged, including gold, which was down a mere $1 per ounce from yesterday's New York Stock Exchange close, whilst silver was down nearly 40 cents per ounce. And adding insult to injury, they resumed the pressure at, what a shock, this morning's COMEX Open, to the point that its low, silver was down 55 cents per ounce, or nearly 4%, whilst gold was down barely 1%, and not a single other market of any kind had moved more than 0.5%. Not that such egregious silver attacks are not commonplace in the world of cartel tactics, but this one was particularly galling in that it was clearly targeted at pushing silver away from its 200-day moving average. To wit, my good friend John Embry wrote me this morning saying, quote, Andy, I think the cartel read your excellent piece yesterday and threw a hissy fit, saying, we'll show that guy what peak manipulation looks like. Of course, when I wrote of said Sunday night paper massacre, which occurred on July 19th, I titled the article, Sunday Night Paper Massacre and the Upcoming Guaranteed Physical Shortage, noting, as in the aftermath of the 2008, 2011, and 2013 paper raids, that all they achieve is exploding physical demand, vanishing inventories, and further production declines. Not surprisingly, the physical shortages this blog has discussed ad nauseum commenced right after the July 19th raid, and despite half of silver's losses and all of gold's having been recouped as I'm in the process of finishing the script, with the prospect of additional fireworks when the FOMC September 17th minutes are released 2 hours from now, there is little doubt such demand will reawaken as a result of such a transparent attempt to suppress it. Not to mention from hordes of traders smelling blood and realizing that an unprecedented combination of positive fundamentals and unusually resilient price movement make it increasingly likely that the 200-day moving average will be again breached to the upside, and likely short afterwards, the 50-day moving average, currently at $14.88 per ounce, will do so as well. That said, forget all the trading mumbo-jumbo for a second, and realize that the game being played here is with your savings, your livelihood, and the futures of your children and grandchildren. Make no mistake, the horrific political, economic, and subsequently monetary trends will only get worse in the coming weeks and months, until inevitably the aforementioned historic fiat Ponzi scheme implodes as violently in first world nations like the US and Germany as in emerging markets like Brazil and Argentina. To that end, we can only reiterate as vehemently as possible that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint, and can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. Consequently, if you are considering the purchase, sale, or storage of precious metals, we simply ask you to give us a call at 800-822-8080 and allow our staff of professionals, on average sporting nearly 25 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks, and have a great weekend.